Hello, First Quantum Leader, and welcome to the fifth and final unit of understanding the elements of the balance sheet. Today we'll be looking at the concepts of depreciation and amortization. In the last unit, you were asked to identify an asset that is no longer fit for purpose and consider whether it should be replaced or repaired. How did you get on? If we replace it, this will potentially have a big impact on our income statement. Yet if we repair it, then maybe we will only extend its useful economic life by a year or so. Sometimes it's a difficult decision to make as to whether to replace or repair. In the first unit, we looked at an overview of the balance sheet, and in the second unit, we examined the sources of capital, debt and equity. In the third and fourth units, we looked at what a company does with that capital. Unit 3 focused on working capital, and Unit 4 looked at investment capital. In this final unit, we'll be examining the concepts of depreciation and amortization. So your task at the end of this unit is, in the next week, identify the useful economic life of a piece of machinery and the implications of scrapping it early. One of the principles of accounting is called the matching concept, also known as accrual accounting. The matching concept states that we recognize income when we've earned it, not when we send the invoice or receive payment. We recognize a cost when it is incurred, not when we receive the invoice or make payment. Let's imagine that you buy a table for $100. This purchase is known as a balance sheet transaction. Your cash has gone down by $100 and your assets, table, has gone up by $100. There's no effect at the time of the transaction on your income statement, as you are no better or worse off. Your net assets remain the same. Now let's say that you intend to use the table for 10 years, after which time it will be thrown away. You can see that buying a table for $100 and using it for 10 years is the equivalent of the table costing you $10 per year. This is the stated aim of depreciation, to match the cost of an asset to its useful economic life. Note, it's not about trying to reflect the market value of an asset. Now let's look at an example. Imagine you have a new company digger, let's say a $160,000 Caterpillar. Nice digger. You're going to drive it around mining sites for 15 years, and in 15 years' time you plan to sell it for $10,000. The annual depreciation charge will be the cost, $160,000, less the residual value $10,000 divided by its useful economic life, 10 years, which works out at $10,000 per year. In our example, we'd have to estimate the residual value. Often this is nil, or may even be additional costs due to decommissioning costs. This is relevant for First Quantum, as you cannot just abandon an old mine, you have to make good the site. In our example, we would depreciate our digger on a straight line basis, which would look like this. So in year 5, our digger would appear in our balance sheet as a cost $160,000, less the accumulated depreciation. That's 5 years at $10,000 per year equals $50,000, which is $110,000. In year 10, our digger would appear in our balance sheet as cost $160,000, less accumulated depreciation. That's 10 years at $10,000 per year, which equals $100,000, which is $60,000. Now, you know as well as I do that the value of the digger does not move in a straight line. As you drive off the forecourt, the market value falls significantly, then it levels out, then it falls into a mine, so the value falls again, then you rescue the digger and have it repaired, so the value levels out again, and finally it's valued at $10,000 in 15 years' time when you sell it. So you can see the market value, which is what it would be worth if you sold it, is not the same as the book value, that is the cost net of any depreciation charged that appears on your balance sheet. If we were to sell the digger in year 5, the market value might be $90,000, while the net book value, the amount at which it appears on our balance sheet, is $110,000. In this case, we would make a loss on disposal of assets of $20,000. If we sold the digger in year 10 for $70,000, when the net book value is $60,000, then we would make a profit on disposal of assets of $10,000. This profit or loss would be reflected in the income statement in the other income and costs line just below the operating profit. So you can now see the implications of scrapping a piece of machinery before we've used it for its whole economic life. If you have an asset in your balance sheet at a value of $100,000 and you scrap it, then you have to recognize that as a loss of $100,000 in the income statement. Much better to keep using the asset, if you can, over the remainder of its useful economic life, even if it requires additional repairs. An alternative approach to straight-line depreciation is called reducing balance. Here, assets are reduced in value by a specified percentage of their net book value. So if we depreciate our digger on a, say, 25% reducing balance basis, then the first year's depreciation charge would be 25% of $160,000, being $40,000, and leaving a net book value of $120,000. The second year's charge would be $30,000, being 25% of $120,000, and so on. Finally, a word on amortization. While we depreciate tangible assets, those are assets that you can touch, we amortize intangible assets, which are assets that you cannot touch, such as intellectual property rights, patents, licenses, etc. First Quantum is mainly a tangible asset business, mining plant and machinery. And so, as First Quantum does not have a lot of intangible assets, amortization is less important to the business. So, depreciation is the process by which the cost of an asset is matched to its useful economic life. Amortization is exactly the same as depreciation, but applies to intangible assets as opposed to tangible assets. So, on to your task for today. In the next week, identify the useful economic life of a piece of machinery and the implications of scrapping it early. So that is the end of this commercial skills course looking at the balance sheet. Let me now summarize the 3 key things to remember when looking at a balance sheet of a company. 1. The balance sheet shows how a company is funded through a combination of debt and equity, which together makes the capital employed in the business. 2. The balance sheet also shows how much of that capital is used as working capital to fund the day-to-day operating activities of running the business. And 3, finally, the balance sheet shows the amount of investment capital, the property, plant and equipment, which is used to generate a return for the business. I really hope that you've enjoyed this course and are starting to feel more confident about the financial strength of First Quantum.